Welcome to another episode of 5 by 5 with CompStak. I'm your host, Brian Caldwell, and we've got an exciting show today on the Orange County, California office market with our special guest, Mike Adams here from Stream Realty. Welcome, Mike.
Thanks, Brian. Excited to be here.
Awesome. We're excited to have you. Why don't you talk to us a little bit about yourself, and then we'll get into the session here.
Yeah, perfect. Well, again, thank you very much for having me. I'm really excited to be here. First and foremost, my name is Mike Adams. I am born and raised in Southern California. Uh, Current title is I'm the market lead within the Orange County office at Stream Realty Partners. There, we assist owners and tenants in buying, selling, and leasing office properties and office spaces. Our current clients, or most of our clients, are high net worth individuals, family offices, asset managers, and owners of businesses. We've got, call it, three different verticals that we work in. We help do third-party leasing and management for office buildings. We sell buildings in the missing middle. Think 10,000 feet to 50,000 feet, and we represent tenants. One organization that we represent is Saddleback Church, and that's really special because there's a purpose to that real estate. And so all things real estate in Orange County and all things office.
Awesome. Thank you for that. Great. So before we get into a little bit of a deep dive into the market and conversation with Mike, I want to share some stats for our pulse check that our real estate intelligence team at CompStak has pulled from our data. Starting with Orange County office average rental rates. And just to note that in California, they quote rates on a price per month versus price per year. So you will notice a slight variation in the numbers here. So in terms of average office rent for Orange County Class A office, CompStak is showing $3.01 per month. That's about 4.3% of an increase year over year, but still about 10.8% below pre-pandemic levels in 2019. When you compare the Orange County office market to the national office market, Orange County is down 10.8% from pre-pandemic levels, while the national Class A office market is up nearly 30%, which is a pretty significant 40-point gap. In the last pulse check, a data point from CompStak data is showing life in the healthcare sector, where 3 of the last 5 highest rent deals in the Orange County office market were in health or life science tenants. And I'm sure Mike will have a little bit more on that when we discuss here. So Mike, why don't you lead us off talking about headwinds and tailwinds that you're seeing in your work?
Yeah, first and foremost, thank you for that. I would also say sorry for throwing you a curveball and making you do things on a monthly rent basis rather than an annual basis. I know that can be a tongue tie sometimes, so appreciate that. So from tailwinds, I like to keep things in threes. Return of positive absorption, vacancy rate reduction, and flight to quality. So first and foremost, the return of positive absorption. In Q1, we saw positive absorption of 385,000 feet. And the quarter prior to that was also positive absorption. And those were the two biggest quarters that we've had since COVID. From a vacancy rate reduction standpoint, we have seen it was a year-over-year reduction. So last year at this time, it was 17.3%. This year, it is just shy of 16.1%. And we're seeing a real flight to quality. And I would say that that term is overused. But when we're looking at our market report, we track, call it 95 million feet of institutional office product. And we've got it broken down into tiers. Tier 1 is 50 buildings, the 50 top buildings in our market. And if you look at that vacancy, it's sub 10, it's 9.8%. Now, I would say I am a optimistic person by nature, cautiously optimistic. Actually, one of my favorite books is Learned Optimism. So I don't like to talk about the call it headwinds as much, but if we're going to talk about some of the challenges, I would also break that down into 3, call it categories. Leasing velocity is weak. Class A, Tier 3 is very exposed, and the capital markets are still very selective. So if we're to talk about leasing velocity, we track metrics both pre-COVID and after COVID. So pre-COVID, the average quarter had a leasing velocity of 2.6 million feet. Last quarter, we had 1.5 million feet. So we still got some work to do from a leasing activity standpoint. Uh, Commodity office space, we talked about it. That Class A Tier 3, that's close to 27% vacant. So, there's really some holes there, and some owners are going to have to start asking themselves some tough questions. And then capital markets, we talk about that being selective. I think Orange County is a little bit of an anomaly in that we've had some users really step up and acquire bigger buildings. But from an investment standpoint, you're seeing people still focused on basis, distress, and discounts.
Great. Yeah. Good info there. Thanks for that. Next, let's talk about your market outlook. So let's take a look at kind of near term, next 6 months, a year from now, and then what are you seeing or predicting for 24 months and beyond?
Yeah. So again, break this down into three things. So 6 months, it'll be stabilization. 12 months, it'll be separation, and 24 months, it'll be investable. So, digging into, call it stabilization, you're going to see an increase in leasing velocity and a bifurcation. You'll see even more gap in between the winners and the losers. Next I'll say separation. Those winners will continue to win, and you'll see extended pricing momentum. And so like the best product will really be able to push rates. And then investable, right? So I think the people that took the contrarian approach, the people that are buying office today, the people that bought office 12 months ago, the people that, weren't afraid to go and buy office, they will be handsomely rewarded. They will, we'll see recaps. We'll see those guys clearly exit. People will know where the office market is. And, depending upon the market, depending upon the submarket, you'll start to see, talk of, and even people building cranes and in talk of spec development. Not in our market because that typically doesn't happen in our market, but you'll start to see some cranes.
Yeah, talk to us a little bit more about the folks who made the office investment in the past and what the mechanics are as far as them reaping the rewards of those investments in the past, 2 years out or more.
Yeah. So here's what I can say is, there are buildings that I think will probably be trading north of $1,000 a foot, like kind of on a national basis. And so once people start to see that office is safe and investable, and like, people start to get rid of some of the negative connotation and negative headlines of the office market. Uh, I think office will once again be a top asset class, um, you know, for real estate investors, like it was, call it 10 years ago.
Yeah. Yeah. And nationally, of course, as I mentioned, we're seeing increases up, I think 30% of Class A, what you guys would call Tier 1 office. So office at the highest levels has certainly rebounded post pandemic. It's just that middle tier and certainly the commodity office space that is still struggling by the numbers. So
Yeah, absolutely.
great. Let's talk about your biggest surprise. So what has been most surprising to you over the past, couple years as far as the office market and what you're seeing out there?
Yeah, so I would say this is something that we're seeing on a day in, day out basis. And actually, we're in the process right now of putting together a thought leadership piece on this because it's such a hot topic in Orange County. So what you're seeing in Orange County is a lot of, call it, the 2 to 3 story suburban office product on larger pieces of dirt. The higher and better use is some sort of scrape and rebuild, right? And so a prime example, we sold a building in Lake Forest, and on a per square footage basis, the building probably is worth $195 a foot. We sold it to a developer for 315 a foot. That's a 42.3% increase, right? And so, the seller, who's the office owner, likes it because they don't have to put any more TIs into it. They don't have the operating costs, et cetera. Now, it can be a little bit challenging because sometimes there's a little bit of a a Hail Mary. No, I wouldn't say Hail Mary, but the entitlement process can be, sometimes lengthy. And so it's not like a 30-day look and a 30-day close. It can be 6 to 9 to 12 to 18 type months and potentially get rid of some tenants. So it's definitely a more sophisticated transaction, but the light is definitely at the end of the tunnel for certain office owners. Uh,
Yeah. And talk to us a little about the entitlements in Orange County and maybe is it more friendly to these conversions than LA County? Or talk to us a little bit about the differences between the two locations and office to residential conversions.
Yeah, I mean, I here's what I can tell you is it's very interesting, right? So we put a deal in Lake Forest under contract for a developer client of ours. Um, the CCNRs precluded residential. It was in 2018. And so it was under contract. We spit the hook on the deal. Last year we ended up closing on it, and that's because, there's new regulations that say that CCNRs or associations can't get in the middle of certain types of development. So what we're seeing on the residential front, it's substantially, it's easier and can be a quicker process from start to finish. I don't myself know really the back of the house for the Los Angeles market. Here's what I can tell you. I think we're about to announce a Los Angeles team here in the next day or two, or maybe week, hopefully. So as soon as that happens, I will connect you with them, and they can come on and give you all the intel you want on the LA market. I'm more focused on Orange County.
Gotcha. Yeah. Thanks for that. And that's definitely interesting nuance there. Um, Anything else in the surprise bucket outside of the what you mentioned?
Yeah, I mean, here's another, kind of quick and interesting fact. The sublease vacancy in Orange County is 1.49%. So, really to me, that means we've sifted through like a lot of the good sublease opportunities, which is great for the overall market because that means tenants will have to step up to direct deals, which will help the overall uh, just market, right? So when tenants have the opportunity to go into subleases, then they can't take on the direct deals, and they're taking it at on a discount, right? And so if they've got to step up to direct rents, they're now used to a higher rent, and everything is just working more efficiently.
So what I'm hearing is that overall supply is shrinking a little bit from these conversions, and also sublet space is shrinking. So that's kind of driving positive fundamentals and upward pressure on the rates that you're going to see in your tier one office. Is that accurate?
Yeah, I'd say you absolutely nailed it, right? I think it's kind of three pronged, right? So first and foremost, you've got big users are stepping up to go buy bigger buildings, and they're not always using the full building for themselves. So maybe it's a 150,000 square foot building, and they're going into 50, and so that's helping plug some holes. You've got the office demolitions is plugging some holes. I don't know if we talked to the number, but there's close to five in the last 5 years. The average amount of square footage that's been peeled from the market is 535,000 feet. And if you're to look on the future or what's planned, it's close to 4.35 million feet, right? And so that's a meaningful number, and all those tenants are having to find somewhere to go. And we ourselves have represented, a handful of these tenants, and what happens is they're typically in like good class B product. And because a lot of the good class B product is going away, they're having to increase their budget and go into nicer space. That might be, call it like a mid-rise with, structured parking. And so they're having to increase their rent, but they're also having some parking charges, right? And so I would say the people in the B or C that still want their office budget is going to have to go up because those options are dwindling.
Yeah. Yeah. Thank you for that. Great. Moving on to regional expertise. Let's kind of look at the nuance within Orange County and some of the different submarkets there. If you want to share what you're seeing and any interesting storylines there.
Yeah. So The Orange County market, as I've shared, plus minus 94 or 95 million square feet. We've got 5 submarkets in 1,569 buildings. To me, the I guess the submarkets of note are Airport area, South County, and Central County. We're going to focus on the airport area and Central County. Think of the airport area as our nucleus. As the airport area goes, so does the rest of the market, and what happens in the airport area expands out into the rest of the market. So, good news for the airport area. The airport area had 289,000 feet of positive absorption last quarter, and we've seen, call it 3/4 of a drop in vacancy. And the leasing activity just in the airport area was 57% of the overall market. Uh, so, as I said, as the airport area goes, so does the rest of the market. So that is a really good sign for the rest of the market. And just hitting on, Central County real quick. Central County also had positive absorption of 128,000 feet. And so, if you think of Central County, think big government, education, some, healthcare back office type operations. Those are typically larger deals. And seeing that absorption there is fantastic.
Yeah, and you talked a little bit about the types of tenants that are signing leases in Orange County. At the top, we talked about healthcare and life sciences. I think you mentioned government, education. Are there any other sectors that you're seeing that are either moving into the market or moving out of the market for various reasons or causes?
So I knew you were going to ask me that, and so I picked up some information this morning. So we use just a software tool called VTS to track all of our tenants and inquiries, et cetera. And so as of right now in our portfolio, that's just north of 2.25 million feet. And this again is just our portfolio today. Like the inquiries and the deals that we're working on, 16% of them are financial services and wealth advisors. 9% are in either real estate or construction. 11% are in government and education, and 15% are in healthcare. And 8% are law firms.
Yeah, so pretty well diversified there, which
Yeah.
is good to see. So
Yeah, and I would say, like, if you're looking at our WIP or our works in process right now, of the deals that we're working, the larger deals, I would say, law firm, software company, technology company, and believe it or not, even an executive suite operator. Hopefully, this airs in a couple of weeks and that deal's finalized. But if not, maybe we'll have to get rid of that portion of it. But
yeah, we'll see.
yeah. And then, also we track things from a size standpoint. I'd tell you Orange County, in 2025, the average deal size was 3,751 feet. Right now, if you're to look at, what we're tracking within our portfolio, and again, this changes from probably brokerage shop to brokerage shop or, based upon the holes that you have in your portfolio, right? But from 1 to 3,000 feet, that's 51% of the inquiries. 3 to 5,000 feet, 21% of the inquiries, and 10K plus is 8%. The rest of it, I got rid of because those are, I think, of most interest.
Yeah, yeah. Okay. Well, thank you for the regional expertise and kind of to close things out. Are there any notable deals or notable takeaways that you kind of want to discuss or leave us with about the office market in Orange County before we head out?
Yeah, I mean, I think from my point of view, I'm big on acronyms, right? And so, for so long you heard office is dead. Well, here's what I would say is office isn't dead. Undifferentiated office is dead. And we've got an acronym for it. The office that is winning is either doing one or all 5 of these things, and the acronym is scale. SCALE. S is for spec suites, C is for conversion optionality, A is for amenities, L is for location, and E is for experience. We've kind of added a little bit to the E. I think you're hearing a little bit more hospitality. So, we've had this for a couple of months now. I don't necessarily know how you change the scale into something with an H, so I'm going to keep it for
Mhm.
the time being. Um, but to me, and what we try to have our owners and the people that we work with, think a little bit differently. I think there's a lot of focus on, hey, what is the market rent? Right. And, here's a real time story right now. Like, if you're looking in the city of Irvine for 3 to 5,000 feet, Class A properties, you got 41 options. Right. So owners need to change their mindset from what's the market rent to why is the tenant going to lease at my building? And they will definitely have more success. I
Yeah,
would also say, like in California, like I I don't care if you're Democrat, Republican, GOP, conservative, not conservative. There's definitely some politics that potentially can get in the way of some transactions. For example, we've got a client right now that, depending upon some certain legislation that could or could not be enacted in November, they're either going to double in size, so they'll go from 20 to 40,000 feet, or, if some legislation passes, and I'm purposely trying to be kind of cryptic, so, as to keep some folks um, I'm being cryptic just because I don't want the cat out of the bag, but
sure.
they're either going to double in square footage or they're going to put their space on the market because we negotiated a great deal for them on the market for sublease and move to Nashville. Uh,
Mm.
so that's a prime example of like, hey, like we could be a you know a job creator and a job center, or there could be legislation that drives people out. And so that's kind of TBD.
Yeah, and that's an interesting narrative. I'm sure that folks are seeing across the country, given the distribution and polarization of politics and everything that we're hearing nowadays. But that has real impacts on the economy and where companies decide to call home, whether it's in California or other places. So, very real consequences to the policy decisions that are being considered and implemented across the nation. So,
Politics or not, I'm a SoCal boy through and through. We live 8 minutes from the beach, and my family's all here. So to me, and especially in Orange County, because there's like a lack of traffic and lifestyles just great out here. So I'm a big believer in OC and California in general.
yeah. Well, great. Well, that's all we have today. We really appreciate your time sharing with us the office market in Orange County and a little bit about Stream and your team and expansion. Good luck with expanding into LA County. And again, we appreciate your time and look forward to talking to you again soon. Thanks for tuning in to another episode of 5 by 5 with CompStak. Don't forget to check out our other episodes on streaming platforms Spotify, Apple Podcasts, and YouTube. And definitely follow us on LinkedIn for more content from CompStak to like and share.